Welcome back, Focus Learners, to today's Explainer. We're going to completely transform how you view the financial markets today. For most people, let's be honest, the word volatility instantly triggers anxiety. It just sounds like chaos, unpredictability, and, well, losing money. But what if everything you thought you knew about market turbulence was actually the very thing holding you back? Today, we're drawing on some absolutely fascinating insights from Tom Sosnoff, a trader who literally built $2 billion businesses on one single foundational concept: mastering volatility. We are going to deconstruct the psychology of wealth and show you exactly how to take a terrifying buzzword and turn it into a precise mathematical tool for winning. And not just in trading, but honestly, in life. Okay, let's dive into this. When the market starts taking these violent swings, human psychology usually kicks in with a classic fight or flight response. And surprise, surprise, most investors choose flight. They panic, they hit sell, and they go hide in cash. But what if that exact market fear is actually your greatest asset? What if the absolute chaos that terrifies the masses is the precise mechanism that creates generational wealth for the few who actually understand it? To flip that fear into a massive strategic advantage, we first have to totally redefine what we're looking at. So, the crucial point here is how we actually define volatility. It's not just random noise. The absolute simplest way to understand volatility is that it is simply the expected move. That's it. It's a highly accurate statistical measurement of probability and risk. But here is the real magic, the ultimate psychological game changer. Unlike a stock's actual price, volatility has mean-reverting qualities. Basically, it acts like a giant rubber band, almost always shrinking back down to its historical average. It behaves in a predictable, statistical manner over time, and because of that, it's the absolute best vehicle we have for setting reasonable expectations about, well, everything. When you understand volatility in its rawest, most practical form, it fundamentally changes how your brain processes risk and reward. In this explainer, we're going to break down the 4 key reasons this concept builds lasting wealth. Number 1, finding opportunity in mispricing. Number 2, exposing systemic vulnerabilities. Number 3, using volatility as a predictive fear gauge. And number 4, creating capital efficiency. All right, let's jump right into reason number 1, opportunity in mispricing and finding that hidden value. So here's a fundamental truth of human psychology and finance. Real money is made when markets disconnect from reality. Opportunity is almost never obvious. When volatility spikes and the whole market is panicking, asset prices can temporarily tank way below their actual intrinsic value. Or on the flip side, they can get way too expensive because of hype. Tom Sosnoff actually shares a pretty wild anecdote about this with Chicago real estate. Over the years, he realized he never made any real money buying real estate in that city. Why? Because he always bought out of want. It was entirely emotional. He was never buying properties that were trading cheap relative to their historical range. But when he took that same capital and invested in financial assets that were cheap due to high volatility and extreme market capitulation, or when he sold assets that were insanely expensive because of hype, those trades were massive winners. He bought for opportunity, which was dictated by volatility, rather than buying on a totally emotional impulse. Which perfectly tees up this fantastic quote from our source material. Counterparties make emotional and impulse buys, and that's where the opportunity lies. By understanding volatility, you're essentially capitalizing on the psychological missteps of everybody else. While the rest of the market is running around acting out of pure fear or unbridled greed, you're just looking at the math. You're measuring the estimated price range and clearly recognizing when an asset is severely mispriced. That brings us right to our second reason: exposing systemic vulnerabilities and revealing hidden risks. Sustained bull markets are incredibly dangerous psychologically. When everything goes up, everybody feels like a genius. It totally hides the structural weaknesses in a portfolio and masks a complete misunderstanding of the expected move. For example, you can't just build a portfolio entirely out of boring utility stocks and expect massive asymmetric upside. It's just not how they behave. But on the flip side, you can't go load up your portfolio with quantum computing and crypto stocks without grasping that all that unlimited upside is mathematically tethered to a huge amount of downside risk. It is literally impossible to accurately assess your portfolio's true upside or downside potential without understanding the expected move that volatility provides. And this right here represents a really dangerous psychological trap. So Knopf talks about how over his lifetime, he made several non-traditional alternative investments that just totally fell flat. He realized later on that his allocations and deal structures were horribly wrong because he was, as he put it, seduced by the upside. He was treating these alternative investments like they were 50-50 coin flips, but because he wasn't assigning the correct volatility to those trades, he totally missed reality. They were actually priced 90-10 against him. He was literally taking on 90% downside risk just for a 10% probability of that massive upside. Understanding volatility is what protects you from being seduced by the upside when the true risk is totally stacked against you. Let's move on to reason number 3, the predictive fear gauge and real-time risk appetite. You have to realize, volatility isn't just some abstract mathematical concept buried in a textbook. It's a real-time, tradable index of market temperament. It literally tells us the market's current appetite for risk. By tracking it, we immediately know if the market is resting in lazy complacency or crashing into total capitulation. But to use this gauge effectively, we have to split it into 2 camps, historical and implied volatility. Historical volatility just measures what's already happened. It's like driving while staring in the rearview mirror. But implied volatility, that measures how volatile the markets are expected to be in the future. It looks out the windshield. Implied volatility completely eliminates the guessing game. It takes all that subjective human emotion out of the decision-making process and tells you exactly if the options premium currently being priced in the market is rich or cheap. And having this predictive power is a massive leap forward. Just 20 years ago, Sosnoff was a market maker in the CBOE exchange pits, way before modern volatility indices like the VIX were what they are today. Back then, traders literally had to guess if volatility was expensive or cheap. They were totally trading in the dark and frankly leaving tons of money on the table. But fast forward to today and the whole game has changed. Retail traders now have incredibly powerful front-end technology. They have implied volatility rank, or IVR, right on their screens, giving them instant context about the market's fear levels. It is front and center on every single trade page. Which brings us to our final reason, number 4. Creating capital efficiency and improving your cost basis. So how exactly does this fear gauge mathematically translate into high-probability wealth building? Well, it's all about using volatility to create incredibly efficient speculative opportunities. Here is the exact mathematical flow of how this works. Step 1. You wait for a period of heightened volatility, when market fear pushes up the expected move. Step 2. Because everyone is so afraid, option prices become super inflated. Step 3. You can then sell these options to collect that huge premium, which drastically improves your cost basis and mathematically results in a much higher probability of profit. Now, yes, you are limiting your maximum profitability, but you're securing a much higher likelihood of actually winning the trade. It is a highly rational, calculated way to just bypass human greed altogether. And here is the absolute secret weapon behind this entire strategy, the number 2. Remember a few minutes ago when we talked about volatility being mean-reverting? Well, statistically speaking, volatility contracts twice as often as it expands. Let that sink in for a second. It shrinks and reverts to the average 2 times more often than it explodes into chaos. So if you are selling premium during high volatility, you have a massive statistical and strategic advantage because the math is literally designed to revert back to normal. Without short-term time restraints, this mean reversion is an opportunist's absolute dream. So how do you actually put this into practice today? If watching volatility is totally new to you, here's your one big actionable takeaway. Start with IV rank. Looking at individual volatilities for specific stocks can be really confusing to contextualize at first, but IV rank just simplifies the whole thing. It tells you exactly where current volatility sits relative to its own past year. If the IV rank is high, you are usually pretty safe to move forward with strategies that capitalize on that fear. Make it a hard rule for yourself. Always check the IV rank before you ever make a trade. All of this brings us to a pretty profound realization from our source material. Embracing volatility is more than simply a better way to build wealth, it's also a better way to approach life. Think about it. When you stop fearing the unknown and instead start measuring the expected move, when you stop acting on pure emotional impulse and start setting reasonable expectations based on actual probability, you transform from a victim of circumstance into a master of opportunity. You stop being seduced by unrealistic upside and you start making decisions based in reality. We've seen exactly how mastering volatility strips away emotional panic and replaces it with cold, hard mathematical probability. So I want to leave you with this final thought to ponder as you step back into the world. Whether it's an investment, a career change, or just a major life choice, you now know that fear and uncertainty can actually be quantified. So how will you measure the actual risk in your next big decision? Thanks for joining me in this explainer, Focus Learners. Keep analyzing, keep learning, and I'll see you next time.